The U.S. economy is showing signs of unexpected resilience as new data reveals faster than anticipated growth in the second quarter. This robust economic performance has sparked a wave of optimism, suggesting that the country may steer clear of a significant recession or, at worst, experience only a mild downturn. With the U.S. dollar gaining strength for the second day in a row and unemployment claims decreasing, there's renewed hope that the Federal Reserve may not need to implement drastic measures to stabilize the economy. But what does this mean for the future of U.S. monetary policy and global financial markets? As we navigate through a time of uncertainty and fluctuating market sentiments, the key question arises: are we on the brink of a stable economic recovery, or is this just a temporary reprieve before more significant challenges ahead? U.S. dollar gains amid unexpected economic strength. For the second consecutive day, the U.S. dollar has strengthened against major currencies, buoyed by data indicating that the American economy is performing better than expected. Recent figures show that the U.S. gross domestic product, GDP, grew at an annualized rate of 3.0% in the second quarter, up from the previous estimate of 2.8%. This increase has tempered fears of a looming recession, leading many to believe that the economy might avoid a severe downturn. Signs of economic resilience. The stronger than anticipated GDP growth, which rose from the first quarter's 1.4% to 3.0%, has caught many analysts by surprise. This upward revision suggests that consumer spending, business investments, and exports have all contributed more robustly to economic growth than initially thought. Coupled with a drop in jobless claims, which fell to 231,000 for the week ending August 24, the data paints a picture of an economy that is more resilient than expected. The job market, often a bellwether for economic health, also shows signs of strength. While the number of people receiving ongoing unemployment benefits increased slightly to 1.868 million, this figure is consistent with levels seen in late 2021, indicating that unemployment is holding steady rather than worsening. Federal Reserve's next move. The latest economic data has influenced market expectations regarding the Federal Reserve's monetary policy. Initially, there was speculation that the Fed might consider a more aggressive 50 basis point rate cut to stimulate the economy. However, with signs of economic strength and a relatively stable job market, the likelihood of such a substantial cut has diminished slightly. Market indicators now show a 35% chance of a 50 basis point rate cut in September, down marginally from previous estimates. Vasily Serebryakov, an FX strategist at UBS in New York, suggests that the current data aligns more closely with a modest 25 basis point cut rather than a more significant reduction. This perspective reflects a cautious optimism that, while the economy faces challenges, it is not in dire need of aggressive intervention. Impact on global currencies. The strength of the U.S. dollar has had a notable impact on global currency markets. Against the Japanese yen, the dollar rose to a one-week high of 145.55 yen before settling at 144.77 yen. The dollar/yen pair, known for its sensitivity to economic expectations and U.S. Treasury yields, reflects broader investor confidence in the U.S. economy. The euro, on the other hand, has not fared as well. Falling to a 10-day low of $1.1059, the euro has been undermined by disappointing inflation data from Germany and Spain, which has raised expectations of rate cuts by the European Central Bank, ECB. These contrasting economic outlooks have driven the dollar's recent gains, as investors seek the relative safety of the U.S. currency amidst uncertainties in Europe. Month-end flows and market movements. As the month draws to a close, typical market behaviors have also played a role in the dollar's resurgence. Brad Bechtel, global head of FX at Jefferies in New York, explains that month-end flows often see investors adjusting their positions, which can lead to temporary rallies or declines in various assets. In this case, the dollar's recent dip below the 101 mark was seen as oversold, prompting a rebound as investors recalibrated their portfolios. This market activity is compounded by broader economic narratives. The dollar has lost 2.7% of its value in August, marking its largest monthly fall since November 2023. However, some analysts believe this sell-off may have been overdone, especially given the Federal Reserve's cautious approach to rate cuts and the overall strength of the U.S. economy. Looking ahead, key data and global implications. Investors and policymakers are now eagerly awaiting the release of the U.S. Core Personal Consumption Expenditures (PCE) price index, the Federal Reserve's preferred inflation gauge. This data will provide critical insights into inflation trends and could heavily influence the Fed's decisions in the coming months. A higher-than-expected reading could prompt a more cautious approach to rate cuts, while a lower reading might open the door for more aggressive easing. Meanwhile, in Europe, inflation trends are also being closely monitored. Recent data showing a decline in inflation across several key German states, and Spain suggests that the ECB may need to consider easing its monetary stance. This divergence between the U.S. and European economies underscores the complex global financial landscape and the delicate balance central banks must strike to maintain stability. Navigating uncertain waters. As we move forward, the global economy faces a mix of challenges and opportunities. The recent data from the U.S. suggests that while the path to recovery may not be straightforward, there is cause for cautious optimism. However, uncertainties remain, and the actions of central banks around the world will play a crucial role in shaping the economic outlook. In this environment of flux and uncertainty, one must ask, are we witnessing the beginning of a stable recovery, or is this merely a temporary pause before more significant economic challenges arise? What are your thoughts on the current economic situation and the future of global markets? Share your insights and join the conversation.